the non-bank lending space has sort of come about. It's grown exponentially over the last 2 years, but originally it came about to give borrowers, commercial borrowers primarily, a place to go when a bank basically says no. So to fit into a bank's criteria these days, you've got to tick a lot of boxes. Now, there's times where a customer may not tick a certain box, but it doesn't mean that they're not a good client, or it doesn't mean that the project isn't a good project. It just doesn't fit in the bank's metrics. So there was a lot of transactions that basically didn't have a home, but they're good deals. So essentially that non-bank space was created to fill that gap. And what's happened over the last 2 years is that capital has really begun to flow into these non-bank lenders. And when I say capital, I mean money from investors wanting to invest in these funds that lend out to these property projects or these site acquisitions. And the reason why is the returns for investors are very good in comparison to what their alternatives are. So, you know, if I had $1 million to invest as a sophisticated investor, you know, you can go buy a property, which might get you a yield of, you know, between 2 and 3% at the moment.
If you're lucky.
If you're lucky, yeah. You could put it in a term deposit, which, you know, maybe costs you money.
Yeah, I was going to say, it's probably going to cost you money.
Close to costing you money. So what are your choices? So then you start looking at these alternative investments, and you've got these mortgage funds that are offering you, you know, anywhere between 7 to 12, some even higher, 15% returns. Now, yes, risk, reward. Obviously, you know, you're putting your money into a higher risk investment. But then again, you're talking about a secured investment, not the stock market. So you're not putting it into a managed fund that's investing it into the stock market where, you know, your money can quickly just evaporate.
Overnight, yeah.
Yeah. So you're putting it into a fund that's investing that money into a property. So at worst case, if for whatever reason something goes pear-shaped with that loan, the fund manager takes the property, sells it, retains the capital, pays the investors back. So I won't say that it's risk-free, because it's certainly not, but the risk is certainly diminished because of the secured asset. So with this being the case, you've got lots of investors now thinking that's where I want to put my money. So you've had, in the last 2 years, these funds are popping up everywhere because obviously fund managers are seeing an opportunity to you know, capitalize on it. There's a growing you know, property market where people are building and developing. So there's the need for the capital. There's the urge of the investor to want to get the returns. So it's a perfect storm at the moment.